Australian government is deeply concerned about inflation expectations, fearing that the recent surge in oil and petrol prices could negatively impact these expectations. One of the key pillars of their belief that inflation will decrease from this point onwards hinges on the assumption that wage growth will remain stagnant. To support their stance, they need wage growth to stay at or below 4%. However, if the current high oil and petrol price environment persists, it may exert additional upward pressure on wages in the coming year. This prospect is a significant cause for concern for them. Unfortunately, there is not much they can do to directly influence this situation. They must factor it into their policy decisions. Let us speak to our reporter in Australia.
Currently, the Australian monetary policy is quite restrained, with interest rates significantly lower than those in other countries. In fact, our interest rates are approximately 1% lower than international benchmarks and nearly 1.5% lower than those in the United States. Furthermore, our interest rates are still below the inflation rate. The Reserve Bank of Australia (RBA) is making every effort to stimulate economic growth without raising interest rates even slightly. However, if inflation risks continue to develop, they will have to respond accordingly. The recent rise in oil prices, coupled with the overall economic resilience, makes Michele Bullock's tenure as RBA governor appear likely to face challenges sooner than expected. In early August, when the RBA made their initial forecasts, the economy seemed to be slowing down, and inflation appeared to be receding. However, the past 2 weeks have seen unexpected growth and a remarkable increase in employment figures, suggesting that the economy is not slowing down as quickly as anticipated. Additionally, signs of inflationary pressures are emerging, not only due to oil prices but also from business surveys. Therefore, Michele Bullock's initial optimism may be short-lived, and there is a high chance of another rate hike on Melbourne Cup Day. Regarding the peak of the economic cycle, we are potentially very close to it. However, it's essential to manage these risks carefully, as this is uncharted territory. While we have seen historically substantial increases in interest rates, they have only returned to levels that were considered normal not long ago. It's challenging to predict when this cycle will end. The primary goal for the Reserve Bank should be to avoid pushing interest rates up to 5.5 or 6%, as seen in the United States or New Zealand, as that would likely trigger a recession. Taking out additional insurance with a rate hike or two before Christmas may be a prudent policy strategy. Regarding the chances of achieving a soft landing, the economy does appear to be slowing down to some extent. However, the key question is whether it's slowing down enough. Consumers have tightened their belts, resulting in reduced discretionary spending. On the other hand, businesses are in robust shape, and investment spending remains strong. Another rate hike or two might help maintain the soft landing trajectory, as it seems that economies, both domestically and abroad, have demonstrated greater resilience to higher interest rates than initially anticipated. The real risk lies in not taking sufficient action on interest rates, which could allow the economy and inflation to spiral out of control, potentially leading to a recession. Determining the current neutral interest rate is a challenging task. In the long run, our interest rates will need to stabilize at around this level or potentially higher. Australia boasts strong growth fundamentals, and our inflation target is comparatively higher than that of other countries. However, inflation is currently above target, and unemployment, according to most estimates, is below the full employment level. This raises questions about whether the current interest rate is restrictive enough to achieve the desired economic balance. There is a growing concern that it might not be, given the economy's resilience and strong job growth. The Australian dollar's exchange rate is a complex issue. The interplay of commodity prices and interest rate differentials makes it difficult to predict its trajectory. While rising commodity prices put upward pressure on the currency, our interest rates being significantly lower than those abroad exert downward pressure. Currently, the downward pressure seems to be dominant, but a further decline in the Australian dollar could potentially become inflationary, especially as it amplifies the impact of high oil prices on retail petrol prices. Consequently, it is anticipated that the currency will continue to hover in the low 60s, although it's challenging to provide a definitive outlook due to conflicting factors influencing the Australian dollar's movements.
Thank you so much for the detailed report. That is all from the Pak News World. Please subscribe to our channel.